This AI-generated podcast is for general information only and does not constitute financial or legal advice. Listeners should independently verify all information. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 3 June 2026.
You are sitting with a client and you are evaluating a green energy bond. They agree to an allocation for their portfolio. The operational question you have to answer in that moment is, did you just provide a factual market update, or did you cross a regulatory boundary and provide regulated investment advice?
Right, and that exact operational assessment is where we have to start today, because that scenario highlights our primary thesis, which is that in private banking, correctly classifying the specific service provided, specifically distinguishing between discretionary portfolio management and investment advice, is the foundational step that dictates the entire compliance file.
Yeah, and if an institution misclassifies that service, you end up with procedural discrepancies right from step one. You might act without the proper legal mandate or, fail to execute the required suitability tests. Yeah. So today, we're going to examine exactly 3 core takeaways based strictly on this statutory framework.
Exactly. We will cover discretionary management, then map out the advisory services perimeter, and finally examine client categorization alongside how certain fund managers can extend their licenses.
Right. So to properly classify the service as outlined in our primary thesis, we have to start by defining the actual parameters of discretionary authority. What does that specifically require?
Well, this is our first takeaway. Discretionary portfolio management requires a formal mandate granting the firm the authority to make independent investment decisions for an individual client.
Okay, and where is that codified?
The framework is established by the Luxembourg Law of 5 April 1993 on the financial sector, as amended, and Directive 2014-65 EU of 15 May 2014 on markets and financial instruments.
That's quite a mouthful.
It is, yeah. So moving forward, we will refer to these as the 1993 Financial Sector Law and the 2014 MiFID II Directive.
Perfect. So let's look at the specific statutory requirements under the 1993 Financial Sector Law. What is the actual operational reality of this mandate?
We have to look specifically at Article 24 of the 1993 Financial Sector Law. The defining characteristic here is the mandate itself. The client legally grants the firm the power to execute investment decisions on their behalf.
Meaning the firm does not have to see prior approval for each individual transaction.
Correct. They simply operate within the boundaries of the pre-agreed strategy. The portfolio manager doesn't call the client to ask if they should execute a trade on a Tuesday morning.
Right.
They execute the trade because they have the discretionary authority to do so. And critically, under Article 24-4 of the 1993 Financial Sector Law, this service must be strictly tailored to the individual client's circumstances and objectives.
Okay, so these decisions are made on a client-by-client basis.
Yeah.
Which means this is completely distinct from collective pooling, like a mutual fund.
Precisely. Collective management is an entirely different operational function. Discretionary management is fundamentally individualized.
Wait, let me pause you there because I have a very specific technical question about the assets involved.
Right.
You often see sophisticated clients holding diverse, non-traditional assets.
Right.
Does the application of Article 24-4 of the 1993 Financial Sector Law still hold if the client's portfolio consists entirely of non-financial assets, say real estate or fine art?
It does not, no. To fall under this specific regulatory classification, the portfolio must include at least one financial instrument as defined under the 2014 MiFID II Directive.
Okay, so what qualifies as a financial instrument in this strict context?
We are talking about traditional securities, shares, bonds, units in investment funds, or derivatives.
So a portfolio of strictly physical assets wouldn't satisfy the criteria?
Exactly. The regulatory focus of the 2014 MiFID II Directive remains strictly on managing a portfolio containing financial instruments. The operational requirements for physical assets would fall under different commercial laws, but not the specific financial regulatory perimeter.
I see.
And this reinforces our primary thesis, right? Classifying this exact service model dictates the necessary management mandate documentation. If you misidentify what you are managing, your compliance procedures will immediately show operational gaps.
Right, which shifts the entire compliance file. So if the service lacks that discretionary authority defined under Article 24-4 of the 1993 Financial Sector Law, the operational classification has to shift, right? We have to evaluate whether personal recommendations are being made.
Yes, and that brings us directly to our second takeaway. Investment advice is legally triggered the moment a communication constitutes a personal recommendation presented as suitable for a specific client's circumstances.
And this is delineated where?
We find this carefully outlined in Article 24-5 of the 1993 Financial Sector Law.
Okay, so what exactly does Article 24-5 of the 1993 Financial Sector Law regulate regarding these recommendations? What are the actual mechanics?
So Article 24-5 of the 1993 Financial Sector Law establishes the perimeter. A recommendation under this article may concern three specific actions: the purchase, the sale, or the holding of a financial instrument.
Okay.
The critical mechanism here is that once a personal recommendation is made, the activity immediately falls within the investment advice perimeter.
And what are the operational consequences of crossing into that perimeter?
It triggers specific client protection measures and suitability requirements under the 2014 MiFID II directive. The institution must systematically document why this specific financial product is suitable for this specific client,
Taking into account their financial situation and objectives.
Exactly.
So this requires a very careful operational distinction. How must a relationship manager differentiate between a regulated personal recommendation and just the mere provision of information during a client discussion?
The boundary is determined entirely by the specificity of the communication. Generic market commentary, factual product descriptions, or educational information, these do not constitute investment advice.
So if a banker says European equities are showing strong growth, that is just information.
Yes, mere information remains outside the regulatory perimeter, but the legal classification shifts the moment it becomes a personal recommendation addressed to a specific client.
Like saying, this specific bond matches the risk profile we established for your account.
Exactly. They have now provided regulated investment advice under Article 24-5 of the 1993 Financial Sector Law. And to repeat our primary thesis once more, identifying whether a discussion crosses into a personal recommendation determines if the institution must execute specific suitability, discipline, and compliance recording.
Because if they think they're just providing information, but they actually provided a personal recommendation,
then they have procedural discrepancies because they failed to document the suitability.
Right. Okay, so having defined the boundaries of portfolio management and investment advice, the final step is identifying how client categorization and institutional licensing intersect with these services.
Yes, which introduces our third takeaway. The regulatory framework applies to both retail and professional clients, and certain fund managers may obtain specific permissions to offer these individual services without becoming full investment firms.
And what is the statutory basis for this?
This is codified in the law of 30 May 2018 on markets and financial instruments, which we will refer to as the 2018 Markets Law.
Okay, so how does the 2018 Markets Law affect documentation across different client categories? Because I would imagine a highly sophisticated professional client doesn't need the exact same baseline disclosures as a retail client.
Well, the 2018 Markets Law amended the 1993 Financial Sector Law directly, and the operational reality is that the service still requires classification and documentation regardless of whether the client is retail or professional.
Oh, wait, really? So even for professional clients, they remain fully within the framework?
Absolutely. The client category might affect the required protection level, for instance, assuming a certain level of market knowledge for professional clients, but it does not remove the necessity of classifying the service.
Right.
You still must legally define whether you are operating under Article 24-4 or Article 24-5 of the 1993 Financial Sector Law.
Okay, from a structural perspective then, how does this framework apply to authorized alternative investment fund managers? The ones engaged primarily in collective portfolio management. Can they manage individual portfolios?
It requires a clear separation of operational functions. Collective management is fundamentally distinct from private banking portfolio management. However, a fund manager may obtain additional permissions to provide individualized services.
And what is that regulatory extension called?
Practitioners refer to it as a MiFID top-up.
Okay, so how does a MiFID top-up work in practice?
Let's say an alternative investment fund manager operates a pooled logistics fund, but a major institutional investor approaches them and requests a segregated account managed with specific internal parameters. To legally manage that individual portfolio, the fund manager needs authorization to provide discretionary portfolio management under Article 24 of the 1993 Financial Sector Law.
And the MiFID top-up allows them to do that without getting a completely separate banking license.
That is correct. But it is critical to strictly note that this top-up permission only allows them to provide these specific individual services. It does not create full MiFID investment firm status for the entity.
Okay, got it. So the core business remains collective management, but they have the extended legal capacity.
Precisely. And this brings us to a final repetition of our primary thesis. Classifying the specific service, confirming the exact license, and keeping appropriate records under Articles 24 and 24-5 of the 1993 Financial Sector Law form the operational starting point for private banking compliance.
It really all comes down to that initial precision. Well, as we wrap up today, here is a final provocative thought for you to explore on your own. As automated systems become more prevalent in wealth management, how will compliance departments police the boundary between information and advice? If a system analyzes a client's portfolio and pushes an automated notification saying, consider reallocating into these 3 specific equities, is that mere information? Or has the system just provided a personal recommendation under Article 24-5 of the 1993 Financial Sector Law? Navigating that operational boundary is going to be an ongoing technical evolution.
It absolutely is a standard technical evolution that will require strict regulatory monitoring.
Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Listen also to the French edition of the Luxembourg Fundcast.
Subscribe to Bertrand Mariaux and Rigore Media on YouTube. Connect with Bertrand on LinkedIn. Read the full analysis of the podcasts at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.